long-term care insurance is real important in a retirement plan. In fact, many people find it beneficial to start with long-term care insurance long before they retire. I know people, in fact, my own father had a stroke when he was in his 50s and ended up passing away before he was 60. So we never know when that day is going to come when we might need to stay in a long-term care facility or receive that custodial type care, which is only covered out of pocket or with a long-term care type policy. Most insurance plans don't cover it. And we know Medicare doesn't cover it more than a few days after you're admitted to a hospital, and only if you are there for specific reasons and receive certain types of care. So to overlook long-term care, I think, is a big financial mistake. But the caveat to that is financial or long-term care insurance is becoming very, very costly. We had a company last year raise rates across the board 40% and basically tell the world they'd rather be out of the business. We have other competitive companies that have been very competitively priced to get into the long-term care, and over the years have just consistently raised rates to a point where people can no longer afford the insurance. That's probably why less than 14% of senior Americans today even have long-term care insurance, even though there's about a 50-50 chance that you're going to go to a long-term care facility if you reach age 65 healthy. So with those odds, it's definitely worth considering. One of the best alternative plans that I know of, and we use a lot in our practice, is a single premium long-term care policy where you just park some of your savings dollars. Almost everybody I meet has at least some sort of a contingency fund, a savings plan. Maybe it's $50,000, maybe it's $100,000, something there for an emergency. And you know what, when I ask these people, what kind of an emergency would you expect to have where you might need that money? Almost always the answer is, well, this is just in case I get sick, have a catastrophic illness, or heaven forbid, have to go to a nursing home. And when you look at the amount, maybe it's $50,000 or $100,000, you realize that that's maybe long enough to cover yourself for a year, maybe 2 years at the most. Today, who knows what it's going to be in the future. That same money could be parked, instead of in a savings account, in a special policy. It's a kind of a hybrid policy that will allow you to take the money back anytime you need it. It will also allow you to pass it on to your heirs should you die without using it. Oh, by the way, at a multiple more than what you put in. And that would be a tax-free death benefit, just like a life insurance policy would pay. So there's no tax on the growth. It's tax deferred while it sits there in the account, and you can get your money back anytime. The best part is, should you go to a long-term care facility, that policy would multiply itself up to 3 to 6 times its value and pay out over a 5 or 6 year period for long-term illness. Now, most people don't stay 5 or 6 years. In fact, 90% of the people, based on my understanding and statistics I've read, stay less than 3 years. So you've got a good chance you'll have plenty of money from that savings account, if parked in the right spot, to cover yourself for those long-term care costs without being dinged a monthly or an annual fee that someday you can't afford, ultimately losing your policy. So, you know, if you haven't thought about long-term care, you need to. And if you have a contingency fund to set aside for long-term care, you need to learn how to leverage it so that it can actually take care of you when the time comes.